On the morning of January 23rd, 10 men showed up for work at a silver mine in Mexico, expecting a normal shift like any other day, but they never returned home to their families that evening. Right now, as this story is being told on Alex Carter Reports, families in the state of Sinaloa are moving from search areas to morgues to government offices, hoping someone will finally confirm the names of the bodies found in hidden graves near Concordia. For these families, this is not about stock prices, company updates, or mining profits, because it is about fathers, sons, and husbands who left for work and simply disappeared without warning. Before we talk about markets or investments, we need to be clear that the human loss comes first. And nothing about money or shares matters more than the pain these families are living with every single day. The grief is real, the fear is real, and the heartbreak is something that no balance sheet or financial report can ever measure or explain. Still, there is also a financial side to this story that most large media outlets have avoided, and that side affects anyone who has money connected to Mexican silver mining. This is not about making quick claims or dramatic guesses, because what we are doing here on Alex Carter Reports is laying out facts, asking hard questions, and looking at patterns that deserve attention. Today's discussion will go step by step through what happened at the Panuco project owned by Vizsla Silver, and we will carefully examine how the market reacted before and after January 23, 2025. We will also explore the idea that violence in unstable regions can create financial opportunities for people who know how markets react to fear, even if we are not accusing anyone directly. This conversation may challenge what you think about mining investments, especially when those investments are tied to regions facing serious security problems. Vizsla Silver, which trades under VZLA on the TSX and VZLAF on the OTC market, is a junior mining company focused mainly on one major asset in Sinaloa, Mexico. On January 23, 2025, 10 workers connected to the Panuco project were kidnapped by armed gunmen in that region. As investigations moved forward, Mexican authorities recovered 10 bodies in the Concordia area. And so far, 5 of those bodies have been formally identified, while forensic work continues on the others. Mexico's National Mining Chamber confirmed that among the dead were miners Ignacio Aurelio Salazar, Jose Angel Hernandez, and Jose Manuel Castaneda Hernandez, and their names are now part of public records and union statements demanding justice. Family members have spoken to local reporters, with one relative saying that being at the forensic facility was deeply painful, and that there seems to be no justice in what is happening. These words were reported in established Mexican news sources, not rumors or online gossip, and they can be verified by anyone willing to check. From the federal level, Mexico's Secretary of Security and Civilian Protection, Omar Garcia Harfuch, stated that the crime appears connected to ongoing cartel conflict in Sinaloa. Authorities believe that a group linked to the Los Chapitos faction, loyal to the sons of Joaquin El Chapo Guzman, may have been responsible in an area where rival groups also fight for control. Early reports suggest the attackers may have mistaken the miners for people connected to a rival faction, turning a group of engineers and workers into victims of a violent power struggle. Federal prosecutors have said that 4 suspects have been arrested, and the graves in Concordia are now part of a larger investigation into cartel-related violence across the mining region. Think about what that means in simple terms, because a publicly traded company with international investors had workers caught in the middle of a violent territorial conflict. This is not a line buried in a risk section of a company report, because this is a real-world tragedy with real names and real families. After the incident, Vizsla Silver's stock dropped more than 30% in about 1 month, which is a sharp fall for a company that depends heavily on a single main project. The company suspended operations at Panuco and stated that it was focused on supporting families and helping with the search for any remaining missing workers. However, there was also a public comment from Sinaloa's Attorney General saying that the only direct communication her office received from Vizsla was a single 911 call made by a legal representative on January 23rd. According to her statement, it was the families of the missing workers who filed the official missing persons reports, not the company itself. That detail has raised questions about how prepared foreign junior mining companies are to respond to extreme security crises in high-risk areas. CEO Michael Connert released a public statement expressing devastation and offering condolences to the families and the community of Concordia. The wording was respectful and serious, but there's a difference between public sympathy and having strong crisis response systems ready before tragedy strikes. Investors should always pay attention not only to what a company says after a crisis, but also to how quickly and clearly it acts during the first critical hours. When we look at the market side of this event, we must ask whether the 30% drop was simply panic selling, or whether deeper forces could have influenced trading patterns. To be very clear, we are not claiming that anyone coordinated violence for financial gain, because there is no public proof of that in this specific case. What we are saying is that markets react strongly to fear, And anyone who understands that reaction can sometimes position themselves ahead of major headlines. In theory, if someone expected a violent event to cause a stock to fall, they could build short positions or buy put options before the news became public. When the violence becomes known, investors rush to sell, funds with strict social responsibility rules reduce exposure, and the stock price drops sharply. If that happened, profits could be explained away as smart risk management rather than illegal insider trading, especially if trades were routed through complex networks that are hard to trace. Again, this is not an accusation against any specific group, because it is simply a description of how financial systems can respond to shocking events. The key point is that when a single incident can erase hundreds of millions of dollars in market value, investors must understand how vulnerable certain companies are. Mexico produces roughly 23% of the world's silver from mines, which makes it a major player in the global supply chain. Because of that importance, many international mining companies have built large operations across Mexican states. But alongside that production success, there have been ongoing issues involving cartel influence, theft of ore, extortion of operators, and local blockades. When security problems combine with political changes and strong nationalist policies, risk increases in ways that are difficult to measure on a spreadsheet. Mexico's government has already moved to declare lithium a strategic mineral controlled by the state, and in 2022, the Constitution was amended to reflect that policy. A state-owned lithium company called Lithiopar Mexico was created, showing that resource nationalism is not just talk, but written into law. Silver has been mined in Mexico for hundreds of years, and it is deeply connected to the country's history and identity. If future policies extend tighter control over other strategic minerals, investors could face additional uncertainty. While some analysts argue that major mining companies have the experience and security systems to handle these risks, smaller junior companies often lack that level of protection. Large producers may also have multiple operations that spread risk across different areas, while single asset companies are far more exposed to one region's problems. There is also the argument that Mexico's silver production cannot be replaced quickly, which could support long-term demand for assets in the country. However, when violence directly affects workers and operations, risk stops being theoretical and becomes personal and immediate. Mainstream financial media rarely connects cartel violence, political policy, and stock trading patterns into one clear conversation, often because these topics fall into different reporting areas. Here on Alex Carter Reports, the goal is not to create fear, but to look at all parts of the picture, even when that picture is uncomfortable. Investors deserve to know not only how much silver is in the ground, but also what kind of environment surrounds the people who mine it. When tragedy strikes, the human loss must remain at the center of the story, because behind every headline are families waiting for answers. At the same time, capital placed into high-risk regions should be monitored with open eyes and careful research. As this situation continues to unfold, watching legislative changes, security developments, and company responses will be critical for anyone with exposure to Mexican mining stocks. The events of January 23, 2025 are a reminder that geopolitical risk is not an abstract concept, but something that can change lives and markets in a single day. For the families of the miners, the damage cannot be reversed by any stock recovery or policy update. For investors, the lesson may be that understanding jurisdiction risk is just as important as understanding geology or metal prices. When we step back and look beyond one single company, a wider pattern begins to form across Mexico's mining regions, and that pattern deserves careful attention from anyone who has capital tied to silver production. The tragedy at Panuco did not happen in isolation, because the mining belt in Mexico has been dealing with pressure from criminal groups, political tension, and local disputes for years. In Guerrero, for example, the Los Filos mine operated by Equinox Gold has faced repeated shutdowns due to disputes with the local Ejido community of Carrizalillo. These shutdowns were not caused by low metal prices or technical problems underground, but by social conflict and broken trust between the company and the local population. Community leaders accused the company of failing to honor agreements, and operations were halted for extended periods because the people living there refused to allow work to continue. When a local community can stop a major mining operation, it shows that social license is just as powerful as a mining permit. Investors sometimes focus only on resource size and production numbers, but social conflict can shut down revenue just as fast as falling commodity prices. Then there is the case of the Endeavor mine in Durango, which in December 2025 was reportedly seized by armed men said to have backing from municipal and state authorities. This was not described as a random criminal act, but as a situation where local power structures played a role in removing operational control from the company. Even if workers were not harmed in that case, losing control of physical assets means losing revenue, and that directly affects shareholders. When state-level forces appear to align with armed groups, the line between private enterprise and political power becomes blurred in ways that are difficult to manage. For global investors, that type of uncertainty increases the risk premium attached to the entire jurisdiction. Mexico remains responsible for around 23% of the world's silver mine supply, which means the country holds enormous influence over global silver markets. Because of that dominance, many international mining firms have accepted higher risk in exchange for access to rich deposits. For years, companies learned to navigate local relationships, security concerns, and political shifts as part of the cost of doing business. However, the question now is whether those risks are rising to a level that changes the long-term investment equation. Cartels in certain regions are known to tax freight shipments, steal mineral concentrates, and demand payments from businesses operating within their territory. Those activities have often been treated as operational expenses that companies quietly absorb rather than public scandals that shake global markets. But when violence escalates to the point where workers are kidnapped and killed, the situation crosses a line that investors cannot ignore. The Panuco case shows that publicly traded companies are not shielded from the broader security environment around them. When fear spreads, stock prices respond quickly, and that reaction can wipe out years of shareholder value in a matter of weeks. Markets are emotional in the short term, and headlines involving violence trigger immediate selling, especially from funds that must follow strict environmental and social guidelines. Large institutional investors often have mandates requiring them to reduce exposure when human rights or security concerns arise. That means even if a mine remains technically valuable, the company's share price can suffer simply because the surrounding environment becomes politically sensitive. This is where jurisdiction risk becomes more than a line item in a corporate presentation. It becomes a force that can reshape entire portfolios. Some investors argue that Mexico has survived political changes for decades and will continue producing silver no matter who holds office. They point out that major companies like First Majestic, Endeavor Silver, and Pan American Silver have operated there through multiple administrations. These larger firms have dedicated security teams, experienced government relations departments, and diversified operations across different states. Compared to a single asset junior miner, they may appear better equipped to handle sudden crises. There is truth in that argument because scale and diversification often reduce company-specific risk. However, scale does not eliminate systemic risk if the broader environment shifts in a more nationalistic or unstable direction. Under the Morena Party leadership, first with President Andrés Manuel López Obrador and now with President Claudia Sheinbaum, resource nationalism has become more visible. The 2022 decision to nationalize lithium as a strategic mineral was a major signal about the government's direction. The constitutional amendment made lithium exploitation a state-only activity, and a national lithium company was created soon after. While officials framed that move as necessary for energy independence and economic sovereignty, it also showed how quickly policy can reshape ownership structures. Silver has deep cultural and historical importance in Mexico, and it remains one of the country's most famous exports. If future leaders decide to expand strategic control beyond lithium, foreign shareholders could face additional legal or operational limits. Even without full nationalization, tighter mining laws or reduced concession approvals can slow project development and raise costs. When governments adjust rules, companies must adapt quickly or risk losing competitive advantage. From a financial perspective, these policy shifts may create discounts in stock valuations compared to peers operating in more stable jurisdictions. Some investors view those discounts as opportunities, believing that worst-case scenarios are unlikely to happen. Others see them as warning signs of deeper structural change. The difference between a value opportunity and a value trap often becomes clear only after several years. One important factor to watch is capital allocation by major producers. If large mining companies begin quietly shifting exploration budgets to countries with stronger legal protections, that decision may reveal how insiders view long-term risk. Companies rarely make public statements saying a country is too dangerous, especially when they already have billions invested there. Instead, they redirect spending and let their future growth happen elsewhere. Another factor to monitor is how often operational suspensions are described as community issues or security reviews. Corporate language can sometimes soften the true nature of challenges happening on the ground. When similar phrases appear repeatedly across different companies, patterns start to emerge. Financial media often reports on individual incidents without connecting them into a larger narrative. One outlet may focus on political reform, another on cartel violence, and another on commodity prices. But rarely are these threads woven together. Here on Alex Carter Reports, the goal is to step back and view the entire landscape rather than isolated headlines. We are not claiming that Mexico's mining industry will collapse tomorrow. We are not predicting that every company will fail. What we are doing is examining whether multiple risk factors are converging at the same time. When criminal influence, political nationalism, and market volatility intersect, uncertainty grows. Uncertainty increases the cost of capital, because lenders and investors demand higher returns to compensate for higher perceived danger. Higher financing costs can slow expansion plans and reduce profitability. For junior miners that depend heavily on outside funding, access to capital is often the lifeline that keeps projects moving forward. If investors begin viewing the region as too risky, raising funds becomes more expensive or even impossible. That reality can lead to project delays, workforce reductions, or asset sales at discounted prices. Even if the underlying silver deposit remains valuable, financial stress can weaken a company's position. Another area worth watching is trading behavior around major security incidents. While we are not accusing anyone of wrongdoing, unusual spikes in short interest or options activity can raise important questions. Regulators have access to data that the public does not, and they are responsible for investigating suspicious patterns when necessary. Transparency in markets depends on trust that no group is exploiting violence for financial gain. If investors begin doubting that fairness, confidence in the entire system can erode. Confidence is a fragile asset, and once lost, it takes years to rebuild. For now, the facts show that on January 23, 2025, 10 workers were kidnapped, 10 bodies were later recovered, and Vizsla Silver's stock fell more than 30% within about 1 month. Those are verifiable points in a larger and more complex situation. Behind every percentage drop on a chart are real people whose lives have changed forever. Markets can recover over time, but families who lose loved ones face a permanent loss. As investors, separating emotional reaction from rational analysis is necessary, but ignoring the human cost would be wrong. The mining industry depends on workers who take real physical risks every day. When those risks expand beyond workplace hazards into violent conflict, the entire investment thesis must be reviewed carefully. Silver demand may continue rising for industrial and technological uses, but supply chains rely on stable regions. If instability spreads, global pricing dynamics could shift in unpredictable ways. Investors should always ask whether the reward truly matches the level of risk they are accepting. Diversification across jurisdictions can reduce exposure to a single country's problems. Researching local political trends can provide early warning signs of policy change. Following independent journalism in the region can reveal stories that international outlets overlook. Staying informed is not about fear, but about preparation. The world of mining has always involved political complexity, but today's environment may be entering a new phase. When we combine cartel activity, state policy shifts, and market sensitivity to social issues, we see a mixture that deserves close attention. In the next phase, we will examine possible future scenarios, discuss what investors should monitor in the months ahead, and explore how global silver markets might respond if Mexico's risk profile continues to rise. Now, let's talk about the road ahead, because what matters most to investors is not only what has already happened, but what could happen next if current trends continue in the same direction. When you look at Mexico's mining sector today, you're not just analyzing rocks in the ground or production forecasts for the next quarter, because you are also measuring political will, security conditions, and long-term national strategy. The first thing to watch closely is the legislative calendar in Mexico, because policy changes often begin quietly before they become major headlines. If lawmakers start discussing broader definitions of strategic minerals beyond lithium, that would be an early signal that silver and other metals could face tighter state oversight. The legal structure for stronger government control is already partially in place, and expanding it would not require rewriting the entire system from scratch. When a government frames resource control as a matter of sovereignty and national pride, it can build strong public support for policies that limit foreign ownership. Silver is deeply tied to Mexico's identity, and any move to protect it under nationalist messaging could resonate with voters. Even without direct nationalization, stricter concession rules or new taxes could change the economics of mining projects overnight. Investors should pay attention not just to what politicians promise during campaigns, but to what they quietly pass into law once elections are over. Another major factor is security on the ground in mining regions, especially in states like Sinaloa, Guerrero, and Durango. If more incidents occur involving kidnappings, blockades, or armed takeovers of facilities, that would signal that the risk environment is expanding rather than stabilizing. Companies often describe such events in careful language, but local reports may reveal a clearer picture of what is really happening. Operational pauses described as temporary reviews may sometimes hide deeper security negotiations behind closed doors. When similar patterns appear across different companies, investors should ask whether these are isolated events or signs of systemic instability. Markets tend to react sharply to sudden news, but they adjust slowly to long-term structural change. That delay can create a false sense of stability if stock prices recover after an initial drop. A 30% fall followed by a partial rebound does not erase the underlying risk that caused the fall in the first place. The broader silver market also deserves attention, because Mexico's role as a major supplier means any disruption could influence global pricing. If production slows or becomes unpredictable, supply constraints could push silver prices higher in the short term. Higher prices might temporarily offset operational challenges for producers, making profits appear stable even as risk rises. However, relying on price increases to compensate for instability is not a sustainable strategy over many years. Long-term investors must consider whether a region can support steady production without constant disruption. Another key indicator will be how international mining companies allocate their capital in the coming years. If exploration budgets begin shifting more aggressively toward countries with stronger rule of law, that may signal quiet concern inside corporate boardrooms. Executives rarely criticize host governments publicly, especially when they depend on those governments for permits and approvals. Instead, they move future growth elsewhere while maintaining existing operations as long as possible. That slow redirection can speak louder than any press release. Investors should also monitor insurance costs for mining operations in higher risk areas. When insurers raise premiums significantly, it reflects a calculated assessment of increased danger. Higher insurance costs reduce profit margins and may discourage new project development. Banks and lenders also adjust their lending terms when political or security risk increases. More expensive debt or tighter loan conditions can limit expansion plans for junior miners who depend heavily on outside funding. For single asset companies especially, losing access to affordable capital can be devastating. Large producers may be better positioned to absorb shocks, but even they are not immune to national policy shifts. If future legislation places additional controls on exports or revenue sharing, profit projections could change quickly. The interaction between criminal influence and formal political power is another area that investors must observe carefully. When reports suggest that local authorities are aligned with armed groups in disputes over mining assets, it blurs the boundary between public governance and private force. Such situations create uncertainty that is difficult to model in financial spreadsheets. Markets prefer predictable environments, even if those environments involve moderate taxes or strict regulations. Unpredictability, on the other hand, is what drives higher discount rates and lower valuations. Some investors argue that risk is always present in emerging markets, and that experienced operators can navigate it successfully. There is truth in that view because mining has historically operated in challenging regions around the world. However, the combination of cartel activity, resource nationalism, and high global attention to social responsibility may represent a new level of complexity. Funds that manage pension money or university endowments must consider public perception as well as financial return. Negative headlines involving worker deaths or violent conflict can trigger reviews of investment policies. That type of institutional reaction can move large amounts of capital quickly. Retail investors may hold through volatility, but institutional shifts often drive major price swings. Transparency will also be critical moving forward. If regulators examine trading patterns around major security incidents and publish their findings clearly, confidence in market fairness can be maintained. If questions remain unanswered, suspicion can grow even in the absence of proof. Trust is a foundation of global capital markets, and once shaken, it takes time to rebuild. At the same time, we must remember that behind every financial chart are real communities affected by these developments. Workers enter mines to earn a living for their families, not to become part of geopolitical debates. Local communities rely on mining jobs for economic survival, especially in remote regions with limited alternatives. When operations shut down due to violence or policy disputes, those communities suffer economically as well. Therefore, the future of Mexico's mining sector is not only a story about investors, but also about livelihoods and stability for thousands of families. Governments must balance national interests with the need to maintain employment and attract foreign investment. If that balance tilts too far in one direction, long-term economic growth can be harmed. International investors should evaluate whether current policies encourage partnership or create friction. Watching speeches by President Claudia Sheinbaum and other senior officials can provide insight into future direction. Policy tone often signals upcoming regulatory changes months before they are formally introduced. Elections also play a role because political momentum can shift quickly in response to public opinion. If voters demand stronger state control over natural resources, politicians are likely to respond. On the other hand, if economic slowdowns increase unemployment, leaders may soften positions to attract foreign capital. This dynamic tension makes forecasting challenging but not impossible. Investors who follow both political developments and security reports will be better prepared for sudden changes. Diversifying across multiple mining jurisdictions remains one of the simplest ways to manage exposure. Countries with stable legal systems and lower levels of organized crime may offer slower growth but greater long-term predictability. Balancing high-potential regions with lower-risk ones can reduce overall portfolio volatility. For those already heavily invested in Mexican silver stocks, reviewing position size and risk tolerance may be wise. Risk management does not mean panic selling, but it does mean understanding worst-case scenarios. A permanent loss of capital is very different from temporary market swings. If a project becomes unworkable due to policy or security changes, recovery may not be possible. As we move forward, the key is not fear but awareness. The events of January 23rd, 2025 were a tragic reminder that operational risk can quickly become human tragedy. They also highlighted how closely connected global markets are to local realities on the ground. Silver demand for electronics, solar panels, and industrial use is likely to remain strong in coming years. However, supply reliability will shape which companies benefit most from that demand. Investors who stay informed, question assumptions, and monitor both financial and political signals will be in the strongest position. Now, let's bring everything together in a clear and direct way. Because after looking at the human tragedy, the market reaction, the political direction, and the broader mining landscape, the real question becomes simple. What does all of this mean for the future of Mexican silver mining? And what does it mean for investors who have money tied to it? On January 23, 2025, 10 workers connected to the Pánuco project were kidnapped, and later 10 bodies were recovered in the Concordia area, with 5 formally identified so far. Vizsla Silver's stock dropped more than 30% in about 1 month after the incident, showing how fast markets react when fear enters the picture. Those are confirmed facts, and they form the foundation of this entire discussion. Around those facts, we see a larger environment that includes cartel conflict in mining regions, community disputes shutting down operations, and government policies moving towards stronger resource control. Mexico still produces roughly 23% of the world's silver from mines, which makes it too important for global markets to ignore. That level of production means many companies and investors will continue operating there despite rising concerns. But importance does not erase risk, and scale does not guarantee safety. The central issue is not whether Mexico will stop mining silver tomorrow, because that is unlikely. The real issue is whether the combination of security challenges and political direction creates a long-term risk profile that investors have not fully priced in. When a country shows signs of stronger resource nationalism, as seen with lithium in 2022 and the creation of a state lithium company, it sends a message about how leadership views strategic minerals. Silver may not be officially labeled the same way today, but it remains deeply connected to national identity and economic history. If future policy expands state influence over mining, foreign shareholders could face new limitations that reduce profitability. At the same time, criminal organizations operating in certain regions have demonstrated their ability to disrupt operations directly. When violence reaches the workforce itself, that risk moves beyond equipment theft or transportation delays. It becomes a moral and operational crisis at the same time. Companies can invest in security teams and crisis planning, but they cannot fully control the broader environment around them. For junior miners that depend heavily on one main project, concentration risk makes every external shock more damaging. A single serious incident can threaten the survival of the entire company. Larger producers may have more protection through diversification, but even they must adapt if the national policy environment changes. Investors should understand that political and criminal risk often develop slowly and then appear sudden when they finally reach headlines. Markets may seem calm for months or even years, and then one event shifts perception quickly. That shift can trigger selling not only from emotional retail investors, but from institutions following strict risk guidelines. When institutional money exits, liquidity drops and price swings become sharper. Another important lesson is the difference between volatility and permanent damage. Volatility creates ups and downs that traders may manage, but permanent loss happens when an asset can no longer operate under profitable conditions. If policy or security conditions make long-term mining impractical, no short-term rebound will fix that structural problem. This is why watching legislative signals, security developments, and corporate capital allocation decisions matters so much. If major companies begin slowly directing new investment outside of Mexico, that could be a quiet indicator of how they view future stability. If insurance costs rise or financing terms tighten, that also reflects increased perceived risk. These signals rarely appear in dramatic headlines, but they shape the long-term investment landscape. At the same time, it is important to recognize the other side of the argument. Mexico has produced silver for centuries, and it has survived political change before. Major producers have operated there through difficult periods and continued generating revenue. Global demand for silver in electronics, renewable energy, and industrial uses remains strong. There are investors who believe that current discounts in Mexican mining stocks reflect fear that may not fully materialize. The viewpoint sees opportunity where others see danger. The truth likely depends on how security conditions and policy decisions unfold over the next several years. No single video, report, or analyst can predict that future with complete certainty. What we can do is measure risk honestly and avoid ignoring uncomfortable information. Here on Alex Carter Reports, the goal has never been to create panic or push a specific trade. There are no paid signals, no secret recommendations, and no hidden positions behind this discussion. The purpose is to connect publicly available facts and ask whether the full picture is being considered. The tragedy at Panuco reminds us that behind every ticker symbol are human lives. Ignacio Aurelio Salazar, Jose Angel Hernandez, and Jose Manuel Castaneda Hernandez were not statistics on a chart. They were workers who left home expecting to return at the end of their shift. Their families are not thinking about market discounts or portfolio strategies. They are living with loss that cannot be reversed. As investors, separating financial analysis from human empathy is neither possible nor responsible. Understanding risk includes understanding the real-world impact of instability. If a jurisdiction combines cartel conflict, community disputes, and a government moving towards stronger state control of resources, the risk profile becomes complex. Complex risk does not always lead to disaster, but it requires careful attention. For those holding Mexican silver exposure, reviewing portfolio balance and risk tolerance is reasonable. Diversifying across multiple countries can reduce dependence on any single political environment. Following local news sources and legislative updates can provide early warning signs of change. Paying attention to company responses during crises can reveal strengths or weaknesses in management. None of these steps guarantee safety, but they improve awareness. The global silver market will continue evolving, and supply chains will adjust over time. If Mexico maintains stability and clear legal frameworks, investment could remain strong. If instability increases or policy tightens further, capital may gradually shift elsewhere. Markets adapt, but adaptation often comes with cost. In the end, the core message is simple. The events of January 23, 2025 were not just a local tragedy, but a signal that operational risk in certain regions can escalate quickly. Investors must decide whether the potential reward justifies the level of uncertainty involved. There is no universal answer because each portfolio and each risk tolerance is different. What matters is making decisions based on full information rather than partial headlines. Stay informed about political developments, monitor security trends in mining regions, watch how companies allocate capital and respond to crises. Ask questions when patterns seem unusual, and always remember that markets do not care about individual hopes or expectations. They respond to reality, sometimes slowly and sometimes all at once. If you have followed this entire discussion, then you understand that this is not about one company alone. It is about how political direction, criminal influence, and global capital markets intersect. It is about recognizing when multiple warning signs appear at the same time. And it is about protecting your capital in a world where stability cannot be assumed. This completes the full breakdown.